victory lap for you, Professor, please, because you saw it, you felt it, you understood it, and what do you see of it now?
It's going to continue. It's not over. We've seen it go above 6% year over year, and I predicted that until this is all over, we're going to get about 25% cumulative inflation. Don't mean 1 year, but over 2 or 3 years, we're going to see the price level really rise by 20 to 25%. So this is not temporary. And by the way, it could get worse unless the Fed gets a handle on money supply growth, because that was the warning I saw early last year. And I do not see enough moderation to give me confidence that it's going to be over soon.
We'll talk a little bit more about that money supply growth here, and I think we can put up a chart of that. I mean, it's still high, Jeremy, not only relative to where it was in 2020, but of course, even today, and you look at it with regards to historical averages, even when you overlay it over other sort of recessionary and stimulative periods for monetary policy, it really hasn't been this strong. And is there any sense here that the Fed has the ability to really draw that down without, I guess, inadvertently creating a economic shock?
Well, I don't think the markets are prepared for how fast I think the Fed has to go. One more report like we got a couple weeks ago on the CPI, and I think they doubled the speed of their taper. They've got to start raising those rates. That's the way you curb the money supply. You raise the rates, get people to pay back those loans, slow down the spending. So much money was created during the pandemic to cushion the economic effects, but that wasn't pulled back. And that is what's flowing in. So the only solution for the Fed is raising. And you're certainly right. We had 34 years of 5.5% M2 money supply growth, 34 years until the pandemic. And it has been increasing at well double digits since then, actually over 25 to 30% in the 18 months since the pandemic hit. So we're way above any previous target or measure that we had.